we've had more gold buying by central banks since the late 1960s, over just the last quarter or two. Incredible amount of not us, not the US, but other governments around the world accumulating tons, sometimes hundreds of tons of gold. Why? They fear what's coming, and they're justified.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for November 1st through November 8th, 2022, while supplies last. This week we feature two silver specials. First, we have 2023 Silver Britannia at only $7.89 over spot. Now, while the Royal Mint has already started minting King Charles commemorative coins, this first run of 2023 Britannia still features the portrait of Queen Elizabeth II. Next, we have 90% silver at $11.49 over spot. Prized for its recognizability, easy divisibility, and liquidity, constitutional or junk silver is also in short supply. As Andy Schechtman says, they're not making any more of it. Our constitutional silver is mixed, meaning it may come as dimes, quarters, or both. But either way, it has the same silver content and is only $11.49 over spot per ounce while this batch lasts. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be here, Elijah.
Well, it's great to have you, especially on this day where we're seeing a lot of volatility in the precious metal markets. Yesterday, we saw the silver go below $19. Now it's racing up towards 21. What do you make of the volatility and, I guess, upward move we've seen, if you look at the net move we've seen in precious metals?
Well, actually, we think that those markets have been bottoming, trying to bottom, meaning putting in a base, seeing accumulation over the since July, actually. Okay. And they keep, they have fitful rallies that seem to fail, and then they go back down, and it just frustrates everybody who's in those markets. But actually, we define the action, if you look at it like a GDX chart or a silver chart or a gold chart, since July as accumulation. Meaning, yes, we came down fairly sharply from the March highs early this year, which was people buying war news, which is, you don't do that in gold. Gold has bigger reasons to go up and down than the Ukraine situation. So you had a sharp drop from the March high. But if you'll notice, starting in July, the tone of the weakness in those markets slowed dramatically to the point where it entered a range in some cases. We call that an accumulation range. It's where smart money buys weakness as opposed to chasing strength, okay? Which is really the better way to approach markets after all. So I think we're about to emerge from that accumulation base. I think yesterday's action in particular, which was so negative looking, overtly anyway, on Newmont and Barrick Gold, the two biggest blue chip gold miners, they had a similar, what you call, accumulation range since July. Where basically if you sold them in July, you didn't make any money. It would just, sideways to gradual down. So you're getting sort of frustrated. But then yesterday they collapsed, both of them. In fact, the entire gold sector did not do that. It was just those two major blue chip stocks, which is very interesting. And they had a very sharp dropout through the bottom of the accumulation range. Now, a lot of people would consider that a resumed downside. However, it's our experience, whenever you've seen an old trend, one that's lasted a year or two or three, in this case, more than 2 years from the summer of 2020 high, okay, been under gradual pressure. And in particular, this spring and summer, sharp pressure in the miners especially. And then you see an accumulation range or a rectangle of action. Somebody's saying, hey, I don't care how bad this looks, I'm buying it. Okay. And then when you get a downside breakout through the bottom of that, be very careful in your assumption that that's some kind of negative resumption. In 1987, I caught the crash. This is prior to when I founded MSA. The crash in S&P 500. you had precisely the opposite sort of thing. And if you go back and look at 1929, the top, exactly the opposite. You had a distribution range. In other words, both markets have been rising for years. And then all of a sudden, for several months, there were sellers just repeatedly saying, well, give me out, give me out, give me out. But it didn't break the market. All it did is stall the stock markets. That in 1929, it would be like summer of 29 and the summer of 1987, where you weren't making any further gains. You were just getting sellers stopping the market, not breaking it, stopping it. So you had a distribution range, like a rectangle. And then you broke out in August of 1929, and you broke out in August of 1987 above the top of that very obvious price range. Pardon me for getting so long-winded here. I'm trying to make a point. It's when that breakout was demonstrated to be false that everything reversed. So in September of 1987, after the August surge to a, quote, new high, you drop back down into the range. And all of our momentum work at that time that I was doing prior to establishing MSA was breaking massive momentum floors. Price was slipping back into the range of prior distribution. And that was the trap that ended the bull market. And I think we just probably had the similar thing yesterday with Newmont and Barrick. So while we're watching gold and silver for us looks quite good. It's well ahead of gold now. In fact, it shifted relative performance 2 months ago to gold, back into positive. And sure enough, it's behaved that way. And gold has some numbers about 0.5% above today's high that we'd like to see a week close out above this week or next week. We specify those in our reports. But once we see that, we think it's blue sky. But now with the action that we saw yesterday in Newmont and Barrick, which was isolated, if we see those two stocks abort back up into their ranges, and Newmont's already sort of done it today, and Barrick is just below it. If we see those guys move back up into their ranges, in particular take out the tops of those accumulation ranges, don't be shocked by how fast the upside is. Oh, it might even be a reverse crash situation, where suddenly everything changes overnight. So anyway, we think we're at a very interesting point in those markets. And the other point I want to make is notice what's happened with the stock market. While gold has gone from 1618 the other day, almost up to 1680 today, and silver went from under 19 to almost 21 today, the stock market has tried to rally. Remember the post-Fed rally yesterday, they spiked it up. We've dropped like 200 points since then in the S&P. And NASDAQ is making new low closes, NASDAQ 100, while gold and silver are doing the opposite. So people who think there's a positive linkage between if the stock market goes down, oh my gosh, gold and silver are going to go down. Well, think twice.
That's very interesting because, yeah, it seems like we have been seeing recently some sort of a linkage between precious metals and the stock market. But you're saying that this is kind of the end of that. We're going to see precious metals rise and the stock market continue to fall?
I think that the monetary metals have an historic role. They always have. And that is to retain inherent value, okay, regardless of destruction of the money unit, meaning the inflation in the quantity of the money units. And since 1959, the M2 has grown up almost about 90 to 100% every decade in terms of quantity of money. Okay, especially since early 2020, it really skyrocketed. Now it's flattened lately, but don't look at it month to month. Look at it more broadly. But if you look at the money supply growth since, let's go back to when gold, early 1970s. So let's go back 50 years. M2 has grown 20-fold. Gold has grown 20-fold. Get the point? It protects assets. And I think that it knows, and I'm not the only one to have said, we said this early in the year. Now, yesterday, 2-3 days ago on Bloomberg, Nouriel Roubini, who's a private analyst, a fundamental analyst, has come to the conclusion that the downside in paper assets, especially stock market, due to what the Fed has been doing and what they did before, which they're now undoing, namely inflate paper assets. And now suddenly when they try to deflate inflation, they are. But the inflation they're deflating is paper asset inflation. That it's going to get so out of hand that there won't be an historic comparison. And I fully agree with that. If you go back and look at the 1929 bull market, I think it was from 1923, 24 lows up to 1929. Go back and look at the 2000 so-called dot-com bubble. Go back to 1994, look at the lows then to 2000. Go back and look at the bear market lows in 2002 in the S&P, and then the high in 2007 prior to that real estate collapse that we had through 2009. Those advances were doubles and quadruples at most in terms of from bear low to bull high in the stock market. And all during those times, the Fed was definitely pumping money for various excuses and reasons, including in the 1920s. This time, it's a seven-fold increase in the S&P 500 from its 2009 low to the 2021 high. And for the NASDAQ 100, the leader index, it was a 16-fold bubble. When these guys come undone, and we think they're undone, the unraveling of those excesses will be equal and opposite and very destructive to not only the valuations of those assets, but to people's lives. I saw on TV the other day, they were talking to some middle-aged, middle-class income earner who said, I wasn't able to add to my 401k this year. I needed the money to just pay bills. What they didn't mention is if he had money in stocks or bonds, he not only didn't add money this year, he lost 20 to 30% of what was in his retirement account. So personal pain is going to come from this. And thank you, central banks, for having created this kind of reality. But ultimately, when that reality unfolds, and it's already in the minds of many major central banks, by the way, we've had more gold buying by central banks since the late 1960s, over just the last quarter or two. Incredible amount of not us, not the US, but other governments around the world accumulating tons, sometimes hundreds of tons of gold. Why? They fear what's coming, and they're justified.
That is interesting that you mentioned how it's not the US that is doing that. Why do you think that is? I mean, is it because the rest of the world, I mean, we're on, kind of a dollar standard right now where it's the world reserve currency. The other world is kind of abandoning that, or what is the reasoning why it's not the U.S. buying the gold?
It could be in part what you just said. Yeah, that we're the reserve currency of the world. Well, that's likely to change. In fact, my bet is there will be no single reserve currency of the world soon. In other words, once the dollar ceases to be the core of fiat currencies, they're all worthless. Really, when you get to it. But the better of the worthless. Okay. When it ceases to have that role, and when major transactions occur around the world in various other currencies, like the yuan, and not just the dollar. For instance, the Saudis, I believe, are going to or already have accepted the yuan for oil. It doesn't take too much to change what we think is an irrevocable trend. No, it's not. The dollar is not guaranteed to be the core center of the world. And I think we may go to a diverse preference of assets to use to pay transactions, not just the dollar. And technically, we argue the dollar is probably already topped by our own work. It made its high 2 months ago, and we think now 3 months ago, and we think it's in the process of decline. That will also somewhat help gold. Although the correlation between gold over spans of time is not always directly linked to the dollar. People make a mistake in thinking that. It's not true. Yes, since May of this year, the dollar has been quite strong, dollar index, and gold has been weak. So that correlation seems to be in people's minds. But over longer periods of time, if you look back, the correlation is really not that good.
And I know that you've pointed out that it's important to realize that what we're going into, this phase in the markets, is not just another another market downturn. It's something completely different. Can you expand on that?
Yeah, when you have a central bank And this is a problem with both political parties, by the way. The Republicans claim to be conservative. They don't like government intrusion. But on the other hand, they don't object to the Federal Reserve. Well, the Federal Reserve is like this. What if you had a government agency that said, okay, we're going to dictate the price of beef? Monopoly control over the price of beef to protect the citizens, okay? Sounds like Russia in the 1980s, okay? We don't do that, okay? If the U.S. government tried to do that, the Republicans would object. But they don't object to the Federal Reserve controlling the price of money, probably the most essential commodity in human relationships, is our monetary ability to exchange with one another. And if they control the price of that, meaning interest rates, then how are we supposed, free markets determine prices better than anything. Buyers, sellers, it works. Things change, prices change, demand and supply change. It adapts to reality. But when you have a body of wise men or women from above, people who've never even run a business, okay, telling the world, telling the country what the cost of money is, then if they're wrong, we all suffer the error. It's not just an error committed by one company making a product that nobody wants. They go out of business. Fine. Okay, that's the way markets work. But when a central bank with coercive power, after all, they do have the legality of government to enforce their rules, tell us what the price of money is supposed to be. If they make a mistake, we all suffer from their mistake. Well, for a dozen years, they printed money like crazy. They did QEs. Monetary expansion went berserk. Interest rates were effectively zero. Well, what kind of economic distortions can come from that? I mean, you as a businessman or a local government, whatever, making decisions out a year, 2 and 3. One of the factors in your decision process is, what's the cost of money? How much do we commit because what's the cost of money? Well, if all of a sudden you're giving money like a drug in an arm free, then your assumptions based on the price of money are totally false. Because if that should change back to reality, where money actually costs something, And so the Fed now has done their reversal. The problem is their pin pricking is not going to prick the Bloomberg Commodity Index. In fact, the Bloomberg Commodity Index is up about 20% on the year right now. S&P's down about 25% on the year. NASDAQ down 30% plus on the year. Bonds down an enormous amount. So the bubble they've broken is the inflation distortion of prices that flowed into paper assets for a dozen years. And so when those errors reveal themselves, and I don't just mean the broader errors, but the more specific errors, family planning. You as let's say a middle-class family planning on their budget. Do we buy this house or that house? What kind of debt do we have? Corporations, the whole deal. How much hiring do we do? Part of it's based on the price of money. If that has been distorted for many years, then you've made a lot of errors. And when those errors get exposed, it could be very damaging and very painful, the exposure process. And that's what I think we're facing. The biggest bubble in U.S. stock market history and paper asset history is coming undone.
Now, what do you see then for what we should look for in the coming in the near future for what the markets will be doing? Do you anticipate precious metals from here continuing to rise and the stock market continuing to fall for maybe the next couple months?
This was an interesting conclusion of Nouriel Roubini a couple of days ago, which has been our conclusion all along. That is, ultimately, the Fed didn't know what they're doing, first off, in the prior dozen years. And then now they're breaking their own bubble, which they're not aware of. They think they're doing a Volcker thing, and that's a distorted history anyway. We'll get to that in a minute if you want. But the unraveling of these paper assets, like municipal bonds, high-yield corporate debt, pension funds, okay, these kind of errors are going to force the Fed back into, whether they want to or not, it's going to force them to reverse and go berserk the other way. The longer they hold off on that process of stopping what they're doing and going back to protect the assets that they think have to be protected, the worse it's going to be. Again, I liken it to drugs. They've had the economy on drugs for a dozen years, and now suddenly they yank the needle out and say, okay, you're on your own. Well, it's gone berserk. They've misfed the economy. And so once they realize that, and Roubini made this case, they're going to have to go back the other way. And that means monetary excesses, lowering rates again, but especially the monetary excesses, meaning print the money, buy the bonds. If nobody's going to buy the bonds, we'll buy the bonds. Okay, government's got to be supported. And muni bonds have to be supported. And high yield corporate debt's got to be supported. Remember what they did with mortgage-backed securities. They tried to support that market. It didn't work. But they printed a lot of money in doing it. It's going to be painful. And they will have to reverse course. Well, what's going to be the benefactor of the Fed and the ECB and the BOJ ultimately having to defend a collapsing asset category? Monetary excess. Gold knows that. That's why gold is probably the least down on the year normal portfolio component. Yes, it's a minority component by traditional terms. Normally it's 40% stocks, 60% bonds, that kind of nonsense. And a little bit left for gold, maybe, okay? But it's an orthodox portfolio component. It's down the least on the year. In fact, it's down less than 10%. In 3 days, it may be up on the year. Up on the year, meaning above 1828, by the way. It's where it closed last year. Why is it down the least of all assets? When the Fed is, quote, fighting inflation, do you think gold would be punished more than the stock market or the bond market? No. Because I think smart money knows that ultimately the game they created and are trying to play now will not play out. That ultimately they'll go back to their primary role, which is to print to defend government paper.
Any specific price points you wanted to leave with our viewers to kind of confirm that we have bottomed in precious metals and we're up from here?
I suggest they subscribe to MSA because, frankly, we're about to come out with a report where we're going to focus more on the silver miners because I happen to I conclude, and I have for a while, that silver's going to vastly outperform gold on this upside. It usually does. By the way, in bull trends, silver beats gold by handfuls in terms of percent gain. In downside, it beats it as well the other way. And recently, we've seen that. But when that reverses, expect silver to outpace gold. And I think the silver miners are highly likely to outpace the gold miners. We're going to delve into the silver miners in the next week or so and try to pick some of the miners in the category to see which ones look the best. But as far as the upside goes, we come out with numbers and we adjust them weekly because sometimes the numbers will adjust based on a moving average that might change week to week. But gold has a number. One we've already crossed today. It's a 200-day average oscillator structure. It's not the 200-day average itself. It's the momentum structure that is built when you plot gold in relation to the 200-day average, which is a pretty long average, like 3/4 of a year. Okay, you've crossed that today. You've broken out, and that goes back to March. That trend is broken out above. But there's another number about 0.5% above today's high. If you close a week out above it, monthly momentum says, I'm out of here. Okay, so that's the only number we've got waiting. Silver's already done comparable breakouts. It's been waiting on gold, though. Gold's been the laggard. It's the mama market, though, so you have to pay attention to mama. It may be slower than the others, but it's the one that ultimately determines the game. So, but we think the action we've just seen the last few days, namely the downside followed by the abrupt upside, is probably the turning point.
All right. Well, the website to subscribe to that is olivermsa.com. Any last thoughts before we let you go?
No. I've got an email address under my beautiful picture on the website. You can email me and I'll send you sample reports if you'd like to see what kind of work we do. But that's about it. I think I've been involved in markets since 1975 when gold was legalized. I was a futures broker with E.F. Hutton. So what's that, 47 years? I started MSA in 1992, went to the research side. Most of our clients are institutional. Then we have a lot of retail subscribers as well. But I have never seen a configuration of trend events so pending and so dramatic as we have right now. And I'm not just talking about upside in gold or something like that. I'm talking about across the board, where major asset categories are going to move that way or that way in dramatic ways that will affect individuals' lives, even if you're not involved in those markets. Interesting times.
Definitely is interesting times. Michael Oliver, it's always a pleasure to have you on. And the viewers love your insights here. So thank you so much and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.